Hello and welcome to ET Now. I'm Ashwin Mohan and you're watching Budget 2016, the tax effect, where we're going to analyze the various expectations from India Inc. and the markets as far as the upcoming union budget is concerned. And to throw more light on that front, we're joined by some of the most senior voices from the world of tax. Ketan Dalal, senior partner at PWC, Pranav Sayta of EY, and Dinesh Kanabar, CEO at Dhruva Advisors. We have to cover areas as diverse as indirect tax, direct tax and international tax. Let me start off with indirect tax, and the big ticket item over there, of course, is the GST. And there is an expectation that the budget will perhaps act as a catalyst to the introduction of GST at a later date. Mr. Dalal, what do you expect related to the GST as far as the roadmap is concerned?
I think, as we all know, the political consensus has to first emerge in terms of the passing of the constitutional amendment bill. The hope, of course, is that such a consensus will emerge, because obviously this can't come in 2016. If at all it can now come, while it can come in the middle of the year, I think from all perspectives that one sees, the logical date now appears to be April 1, 2017. But I think perhaps a two-pronged approach may be necessary. One, as I said, is the political consensus. And second is, if the draft GST legislation is introduced, it will give industry time to engage with the government.
Mr. Kanabar, there is a lot of uncertainty about the rollout of the GST. What would you like the FM to spell out when it comes to this budget?
The couple of things that do seem to come up is the convergence on the rate. We saw the rate of service tax, for example, going up from 12 to 14 and then further enhanced by a Swachh Bharat tax. There's a wide expectation that will move closer towards 18, so somewhere like 16% service tax rate, which at one level is an excuse to say that we are moving towards a rate which is recommended for GST. Another view is really that 18% is compounded with certain offset of credits, which is not happening at a time of 16%. But that's a very widely expected thing. But other than a statement of the government, of the finance minister, to say what is the government trying to do, A, to build a political consensus, B, on the backbone on the IT side, and 3, sort of on a draft legislation, nothing more significant in the budget per se.
Mr. Sayta, do you concur with him that perhaps the elbow room for the FM to spell out anything relating to the GST is very limited, because it's still all up in the air regarding the eventual rollout and the time frame?
I think a couple of other things might happen. One is the threshold that we have currently for service tax, excise duty and so on. For service tax, for example, 10 lakhs might be raised to 25 lakhs. For excise duty, again, there's a threshold of 1.5 crore, 1 to 1.5 crore, whatever. That is far more sensitive to bring down, but that will also have to converge ultimately if we are going towards, if we are serious about bringing in GST. Also, some of the exemptions may have to be pruned and rationalized. And if we are going to quickly move towards a GST, that pruning of exemptions might have to start. And some of the SENVAT exclusions might also have to be converging, so which don't right now happen. So those,
you're talking about a liberalized SENVAT credit regime.
Correct. So those exclusions from the SENVAT credit regime might have to be removed.
Point taken, Mr. Sayta. Now let's move forward from indirect tax and some of the key expectations over there to corporate tax. And there the government has clearly spelled out its intentions to reduce the corporate tax rate in a phased manner from 30% to 25%. Can he give away a big tax cut in the budget given the current economic scenario? How do you see that panning out?
See, I think we have to look at 2 or 3 things. One is, of course, the larger issue, the macro issue. And on the one hand, you have a significant benefit coming in from the reduction in oil prices, and there is enormous headroom there. Of course, against that, you have the Europe commitment, you have the 6th pay commission, you have pressures on rural spending, etc.
So will he bring it down? Is that what is expected?
But more important than that is, I think the phase out of exemptions, which has already been announced from 31st of March 2017, and Ashwin, as you know, we are just 1 year away from that, and the reduction in tax rates are linked. So to my mind, the reduction should happen, if not from this year, at least from the financial year beginning 1st of April 2017. That's one point.
Mr. Kanabar, what figure would you like to see? Because there is a widespread expectation that he will have to bring this down so that he meets that phased rollout target.
The government could do well, at least to meet the expectations of corporate India, by reducing what I believe should be between 1% and 1.5% this year. I think the point which Ketan made earlier, and you read out from the last year's speech, he's spoken about reduction from 30 to 25. In an ideal world, one would want the tax rate to be 25. No surcharges, no nothing. I don't know whether such an ideal situation exists at this point of time. So what I'm expecting is 30 to come down by 1% to 1.5% this year.
Is that the expectation from your end as well, as less as 1% or 1.5% at the max?
Honestly, I'm not too sure any rates reduction is going to be clearly happening this year. I would feel that if the phase out of the exemptions and incentives are going to start only after April 1, 2017, then the reduction in the tax rate commensurately will also happen commencing from that year. But apart from that, I'm not too sure how much fiscal headroom he has for this year, because of the 7th Pay Commission, OROP and so on and so forth, and also the fact that he needs to give some stimulus to the economy.
And that's a fine balancing act he will have to take in mind, reducing corporate income tax rates and phasing out exemptions. And that's the next point, in fact. Can he afford to do that? Because there are many sectors like pharma, infra, who were crying out when recently, a few months back, there was talk from the CBDT about reducing or phasing out the exemptions. And of course, there are two categories, expenditure-based exemptions versus investment-based exemptions. How do you see him playing this balancing act?
There's one thing which many people have forgotten. You know, if you see the BJP manifesto, there are only 5 points on tax. It's just 2 paragraphs. One, there's dispute resolution, simplification, non-terrorism, etc. One of the points was incentivizing research and development. That's one part. You mentioned about Make in India. So in a sense, that is partly linked.
But what the CBDT has done recently doesn't seem to be in sync
so
with that main message.
That I agree, absolutely. They haven't. But the point is that I think somewhere in this whole thing, I think they may need to relook at the fact of research and development incentivization, because you're talking on the one hand of, as you said, Make in India, innovation, many other things. And I think if you see the global context, so for example, UK has many incentives, China has a 150% weighted deduction and a special lower corporate tax for high-tech industries, and US has something which is a differential extra spending 20% of that, for example. So I'm just saying that R&D may need to be looked at separately, but so far as the others are concerned, I would be very surprised if they decide to continue it, given what they've been saying.
All right. Do you also look at it in a basket, that R&D, pharma to be looked at separately because it's
not just
sensitive?
pharma, I'm just saying for R&D.
But what about the other sectors?
So you need to weigh in between what are the fiscal incentives, what are the tax benefits overall to the economy, and what do you need to give up in form of deductions and exemptions.
So basically the government is torn in many directions right now.
Absolutely.
Mr. Sayta, this is a government that has, over the past few months, always been a government which has, before it comes up with anything big ticket, it's always in fact made an effort to get inputs from stakeholders. So therefore it's been a very accommodative government. Keeping that in mind, what is your take on the phasing out of exemptions?
My sense is it's not going to be easy, because one, if they really are serious about bringing down the tax rate from 30% to 25% or 34 to 25%, and that 25% has to be inclusive of surcharge and cess if all exemptions and incentives are going according to me, because we are talking of this 25% not just coming out of thin air. We are talking of this 25% in the context of a global competitive environment, where most other countries have corporate tax rates which are 25% or lower. So today we talk of BRICS, China, Brazil, Russia, Indonesia have all 25% corporate tax or lower than that, except maybe South Africa, which has closer to 28%. So virtually all around, if you look at Singapore, Taiwan, Hong Kong, they will all have 16, 17%. So what we are talking of is an environment globally which talks of a very, very moderate corporate tax rate. And this is in addition to all the other incentives, the patent box regimes or the R&D incentives that one has. So if we have to make India globally competitive in this environment, we must look at a more reasonable corporate tax rate. And I think that should be the aim.
Before we slip into a short break, I want brief comments from all three of you on another aspect that is likely to be included in the budget. And that, of course, is a BEPS compliant regime, base erosion and profit shifting. India has obviously given a lot of inputs over the past few months, and therefore there is an expectation that the country by country reporting rules will be incorporated. Quick thoughts from all three of you on what is the detailing that is required before BEPS regime kicks in.
See, I think there are several aspects to the BEPS regime, and I'll keep it short. One, of course, is the substance over form, and we have GAR coming in next year, and that's going to be another issue as to what happens, for example, to Mauritius when GAR comes in, especially given the state of the capital market today. So that's one aspect. Second is, you talk about startup India, and there are issues on digital taxation, so that's another issue. And the third is on transfer pricing, country by country reporting, and a variety of other things. And the fourth basket is, whether India will sign all the multilateral agreements and make changes.
I want to understand how BEPS will impact Indian conglomerates with overseas presence and also Indian MNCs operating in India. So how will the rules of the game change for them?
I think that's in some parts. So, for example, substance over form, we have had a very strong judicial guard, if I might put it that way. So, for example, the Vodafone case was the tax department seeking to apply what they thought was a judicial guard. And the Supreme Court said that that's not applicable, but that's one example. So, I'm saying some baskets in India has already crossed that barrier. In some other baskets, one will have to look at it. So, it's not possible to give one particular answer, but the 4 segments that I mentioned will need to be looked at item by item, but some of it will phase out over a period of time. All can't come at one time.
All right, Mr. Kanabar, quickly, country by country reporting, it's a given that it will be introduced?
So, country by country reporting really does not require any modification to a law or even a budget.
But some commentary on that bit.
Yeah, there certainly will be certain things which will come in the finance minister's speech on how India is looking at it. More important, there has been this concern regarding confidentiality of information. How will India look at it? I think the more important question is the question you asked earlier, that what happens to Indian conglomerates, Indian MNCs. And I think we had a POEM being introduced last year. That has been, so to say, a stillborn provision, because we have something on the statute, then it was supposed to be backed up by rules. The rules have come out in a draft form.
More than half the year have passed. Yeah.
Half the year,
9 months.
end of the year.
End of the year,
and we don't have the final rules. And the question is, should POEM be pushed back by at least a year? There is this issue regarding the draft rules itself, that while it speaks of POEM, it really is going on to CFC. So in some sense, the law speaks of POEM, and then you are putting off CFC, which again is something consistent with what the BEPS report is all about. So it remains to be seen whether this year we will see a pushback of POEM, an introduction of CFC, yes or no.
Mr. Sayta, if I were a conglomerate and and obviously my tax team would be gearing up because BEPS is inevitable, what would I ideally want to hear in the FM speech regarding BEPS?
Yeah, so I think the finance minister is going to accept much of what BEPS says. But I do not think CFC is coming this year. I do not think thin capitalization or interest deductibility is going to be touched upon this year. That's the feel I have. I do feel, however, some of the basic things, transfer pricing, CBCR, surely should be coming. May not need change in legislation, but he's going to say it's coming and that announcement should be there. There should be more clarity on how that will be dealt with. I do anticipate that there will be a clear focus now that we will have a substance-based taxation where value creation, particularly from a transfer pricing standpoint, is what is going to get taxed.
All right, on that note, we'll have to slip into a short break. Keep watching ET Now. Budget 2016, the tax effect, comes up on the other side of this short break. Welcome back to Budget 2016, the tax effect, where we are analyzing some of the key expectations from Finance Minister Arun Jaitley in the upcoming budget. Now let's talk about the Ishwar Tax Committee recommendations. They were received favorably by all stakeholders, and there's also a hope that many of them will find their place in the budget. Which are some of the key proposals, do you think, that will be immediately adopted by the Finance Minister, Mr. Dalal?
Yeah, so first of all, I think given the short time that was there at the disposal, because they were appointed only in October 2015, I think they've done an excellent job. There are the proposals, I would say, are in 2 baskets. One is substantive and one is procedural. Insofar as the substantive baskets are concerned, there are 4 or 5 proposals which I think are extremely important, and hopefully they will be accepted. The first is capital gain versus business income, where there were a couple of recommendations, but one of the key recommendations is that if it is more than 1 year, consider it as capital gain. So whether it's for private equity, whether it's for strategic sale, I think that may be, or that for that matter, an individual taxpayer, that's one. The second is, and that I think is a very important suggestion, and it was long in the pipeline, this whole issue of taxation of dividend, the concept of economic taxation has been accepted, and the implication of that is that, for example, there was a section saying disallowance of, let's say, interest under a section called 14A. So disallowance of interest is on the basis that dividend is exempt. So the committee has said, but it's not really exempt. Economically, it is being taxed. So I think that's a very important.
And that will reduce a lot of litigation as well.
Yeah, absolutely. Although, of course, so far as dividend is concerned, there is also a possibility that the government may go back to that withholding tax thing. There is a rumor to that effect. There is some noise in the system on that aspect. The third is, they have said defer income computation and disclosure standards. because I think in the current, first of all, I think many things in the income computation and disclosure standards is a acceleration of taxation, which I think is not warranted in the first
probably
place.
it's too much for a corporate to bear with all the
Absolutely.
other compliance issues in
And
mind.
I think it is fundamentally flawed to my mind.
Justice Ishwar panel recommendations, your topics?
So the number of suggestions which have been given on the administrative side, and for the first time there is a degree of accountability which is being brought in, and I think which is very, very welcome. And broadly we have issues with regard to payment of higher interest if refunds are not granted in time. A very, very welcome step will ensure that monies come back. The provisions to say that if there is a refund, if there is a stay granted, then the refunds cannot be held back. Again, a very, very welcome
And
thing.
I'll put some accountability on the tax department as well.
A very interesting provision, and I would be sort of waiting with bated breath to see how does that get accepted. To say you just got to pay 7.5% tax if there is a demand, and you can appeal. And if you believe that even that 7.5% is not warranted, then you can actually ask the Commissioner of Appeals to reduce it. How does this go? It's very, very interesting. Again, several things on withholding taxes, procedural amendments, very, very welcome, and I believe all of them make very. So for example, there is a suggestion which says that merely because there is an audit objection, you cannot reopen an assessment under 263.
Yeah.
That's where reopening happens all the time. And that
again leads to litigation.
absolutely, and that really goes to the situation of uncertainty.
Mr. Sayta, what are your top picks?
So I think it's a brilliant report given the limited time that was available. I think many of the points in that report, if not all, are likely to get accepted in
Which
this
of them?
budget. So for example, the 14A amendment in regard to allowability of expenses is likely to get accepted. The characterization of income between capital gain or business income. I would feel also the provision that says that if I make a claim for during an assessment proceeding for the first time, that should be accepted. Again, a very, very good provision. The provisions in regard to withholding taxes, refund, and to ensure there is fairness in grant of refund. All of these I think are likely to get accepted. I'm not too sure about the stay one, but other than that, I think most recommendations I would anticipate are likely to get accepted.
I'll take a quick straw poll, in fact.
Yes.
I'll take a quick straw poll before I come back to you. The single most important recommendation that you hope will be accepted from the Justice Ishwar panel, and stick your neck out.
Well, I don't think a single most. I think the three that I mentioned and one more, that in days the committee has said that it is extremely difficult to figure out what will be the implication of Ind AS on tax. I didn't mention that, but I think that. So I think all four are equally important, the substantive ones.
So there is consensus over here. Mr. Sayta, go ahead.
I would feel 14A out of the lot. The 14A amendment stands out because of the sheer magnitude of volume of litigation that is there surrounding
So
it.
with one stroke, you'll reduce a lot of litigation.
If we are looking at the Ishwar Committee report as something that brings in simplicity, reduces litigation, brings in fairness and accountability, and improves ease of doing business, I think the 14A one, if one has to be singled out, is the most critical here.
All right, now let's talk about an issue that has kept the markets buzzing in the past few weeks, and that is, of course, the rumor in the market that there could be a possible tweaking of the long-term capital gains tax clause. There is a rationale for it. Some say that it will give an additional 2 years revenue to the government because short-term, you can get 15% short-term for 2 more years. You'll get better and improved quality of investment, and therefore, even if this kicks in, there will be a knee-jerk impact, but in the long run, people will learn to sit up and accept it. What do you think the impact would be if the long-term capital gains tax clause exemption, the time frame is extended from 1 to 3 years? Because that's what is part of the whispers doing the rounds in the corridors.
See, I think first of all, Ashwin, at the time that we are having this discussion, the situation is significantly more volatile than it was 2 months ago.
I know the markets are choppy. Yeah.
Right? To put it mildly. Number one. Number two, we also have the situation that the entire issue of capital gain also has to be looked at. What is the government stand going to be on Mauritius? All in all, my sense is that if at all there is an economic rationale to do what is intended, today is not the time, and I would be very surprised if the government touches it at this point of time. I don't think they will.
Mr. Kanabar, what do you think?
And I'm not sure how many people are currently making gains at this point of time.
Mr. Kanabar, what do you think? And if at all it comes in, you also have that additional element of STT, Securities Transaction Tax. So can the government perhaps come out with some balancing act?
So the point really is that today we have a securities transaction tax of the magnitude of whatever between 6 and 7,500 crores. People, as Ketan mentioned, are not making any significant gains, and really does one want to go down that path. the government has not met its disinvestment target. A lot more disinvestment is scheduled, and I don't think this is the right time for the government to tinker with capital gains. I'll just make one other comment, and Ashwin, as a journalist, you might just like to try and look at this at some point of time. How many rumors do the round before the budget, and how many of them actually come?
Many, and my job is to ask you questions on them.
No. I'm just saying that take a stock of how many people just. In fact, this is one of those rare budgets where, having regard to issuer committee, having regard to TARC report, having regard to this entire proclaim thing on doing away with exemptions and sort of bringing about lower rate of tax, that you almost have a vision of what is happening. It's the first time you can actually say with a degree of certainty that this is what is likely to. One can't predict all of it. So I'm saying that
I'm just saying there cannot be any smoke without fire. That's all.
I don't know about the smoke and the fire, but I would be very, very surprised. I would not sort of want to bet to say that there will be any change in the capital gains tax regime.
Do you think the government will take the plunge, keeping in mind the pessimistic scenario which has been?
Let me play this in two parts. Would they be justified in saying long term is 3 years? I'll stick my neck out and say yes.
Because
it
overseas,
would be reasonable to say that it's not beyond 1 year that our capital gain becomes long term.
And we're not going to do something which is entirely unprecedented.
In principle and concept, I think it's the right step to take.
But in terms of timing.
But in terms of the timing today, will the government have the stomach to do it in today's environment? I think not.
All right. So it's a clear no from all three of you. All right. Now let's move on to the last aspect, and that's an aspect that has got the thrust of the government. There's a lot of emphasis on startups and e-commerce. There's been some commentary recently from the Prime Minister himself about how the community can gear up for some tax swaps. If you look at the budget, what kind of swaps do you expect? There has been some talk about tax breaks, 3 years. There's been some talk about some startups saying that do not tax us on capital gains. How much can the government stretch to provide an impetus to this community?
See, I think I don't know how much they can stretch, but there are several aspects that distinguish startups from companies which are established, and therefore they may need to look at it separately, especially if you want to encourage startups, innovation, digitization, and for that matter even employment and entrepreneurship.
Longer gestation period and no immediate profits.
Correct. Yeah. So I think 2 or 3 things. One is, for example, startups often change hands in the first few years. So there is a section, for example, called Section 79, which disallows the carry forward of loss.
All right.
Okay. So I think that's one thing which they can do. Okay. The second which they can do, as you said, is, and this is of course relating to the shareholders. The first one is relating to the company. The shareholders is, one is ESOPs, because there is a lot of value creation that can happen, but it's very uncertain, very risky. So for every one value creation that can happen, 9 do not happen. But it is on the basis of that one that employees are attracted, talent is attracted. So ESOP taxation, and I can't go into details for want of time, but that is one. And of course, as you said, the possibility of treating capital gains on unlisted shares also as, let's say, exempt for let's say the first few years of a startup. That these could be some of the aspects that they could look at.
Mr. Kanabar, your quick takeaways on startups and the swaps expected for them?
I think the swaps have already been, so to say, announced by the Prime Minister in a broad.
Do you see them being fleshed out a little more in the budget?
Not just fleshed out, actually being implemented by way of changes in the statute. And I think the biggest one is really the ability to attract investments, funding, which is very, very critical, and where the proposition is that if within given parameters an investment happens, and if a disinvestment happens and the gains are reinvested, then there is no capital gains tax. I think that's a very significant move, and I think it's something which I would welcome, because you are attracting investment, to be large amount of foreign investment. You are ensuring that when gains happen, people are able to move out and then keep the money in the country because they are going to reinvest it. That's a very, very welcome step.
Mr. Sayta, your thoughts?
I would feel, India is a country of entrepreneurs, and if we are looking at the startup space, it's really active right now. It can become an engine for entrepreneurship as well as employment generation. I think this government is committed to spur that, revive the animal spirit, so to say, and this will be a great step to revive animal spirits.
Anything specific
Let
that you would
investments be exempt if the capital gain is reinvested back into startups.
All right.
It gives you a chain of startup investments, and it just gives that kind of encouragement to the entrepreneurial activity and employment generation which we are looking for. So I think startup, particularly the exemption to investors, is I think what I would be looking forward to as a great step in this particular budget.
All right, gentlemen, on that note, we have completely run out of time. Thank you so much for taking out time and speaking to us. With that, it's a wrap on Budget 2016, the tax effect. All eyes now, of course, will be on Finance Minister Arun Jaitley. Stay tuned to ET Now for more news and updates.